How long are you going to live? I don't know, and neither do you, but hopefully a long time, and that requires you to have enough income for life. So, one way to do that is through annuities. But how do annuities compare to, let's say, bonds or CDs or other fixed income assets? Today, we're going to talk about that. So, first, what is an annuity? Annuities are insurance products that guarantee income for life or over a fixed time frame. So that could be 10 years, 20 years, up to the terms of the annuity. And the payout can be immediate, so you get your money now, or it can be deferred, meaning that you get your money later, but that also means you get to have growth in the annuity. So there are four main annuity types, or at least the four that I'm touching on. The first one is fixed annuities. Fixed annuities have tax deferred growth, meaning that there is an accumulation of your investment over time. That's you don't have to pay taxes on. And then the payout can be a lump sum, so all at once, over a set period of time, over, say 30 years, or it can be for life. And a subtype of that is the multi-year guaranteed annuity, MYGA. They have a fixed yield over a specific number of years, then it allows for a renewal if you decide to renew at a new rate. Then there's the fixed index annuity. They're similar to fixed annuities, but they track a market index like the S&P 500. Returns are capped, meaning even if the S&P 500 goes to 1,000%, you might get a cap of, say, 15%. But on the flip side, there's a guaranteed minimum, which means if it's a 0 to 2% minimum, then you can never go negative. So there's a cap and there's a minimum. That's what a fixed index annuity is. Then there's the SPIA, single premium immediate annuity. They're funded with one lump sum payment. Maybe you fund it through a 401k, and it gives you an immediate income stream with different payment options. They can be guaranteed for life or for a set guaranteed period of time, or a hybrid of both. If the funds are from a qualified SPIA, that means it's funded with pre-tax dollars. For example, through a traditional IRA, 100% of the income payments are taxed as ordinary income. But if it's a non-qualified SPIA, so you use post-tax money to contribute to the annuity, such as from a Roth IRA, the income payments will contain some non-taxable portion. So some of the payments you get will be taxed and some won't be. It will be a little ratio determined by this exclusion ratio. Then there are variable annuities. Variable annuities are rates based on the performance of an underlying portfolio. They are variable. But we're going to talk about fixed annuities because it's fixed and it won't change over time. So fixed annuities have a death benefit to the beneficiary, which can be taxable. There are complicated rules around that. Or they could just pay out income for life. It depends on how you set up the annuity. Then there are long-term care waivers. So they give you penalty-free access early if you need long-term care, such as through a nursing home. You can also have a terminal chronic illness waiver. If you get terminally ill with some cancer, you can access your funds early that way as well. Many annuities are protected from creditors, so that can provide you some protection. And they are not FDIC insured, but there are state guaranteed associations that insure your money if insurance companies go under. And coverage is different for each state, so you need to look up the rules on your own state, but they're usually at least $250,000. So in Florida, for example, $250,000 for an annuity. In California is 80% up to $250,000, and then $500,000 in Connecticut, $100,000 in Alaska. So check the link in the description below for your coverage amounts and do your own research. So fixed annuities provide tax-deferred growth on your investment that allows for you to get income in the future. So that's an overview of what annuities are, but they also come with some fees. So pay attention. They can come with withdrawal or surrender charges for canceling or trying to withdraw the money early. So if you have a 5-year fixed annuity, if you withdraw it before the 5 years, you might be charged some type of fee for withdrawing early. But there is usually some liquidity. For example, you may be able to withdraw 10% of your funds after the first contract year penalty-free. There are also optional riders that you can add for additional benefits, but they also come with additional cost. And some terminology here. An annuitant is the person receiving annuity income payments. So the person receiving the income. They are charged a 10% early withdrawal penalty from the IRS if they are under age 59 and a half. So if you began a 10-year annuity at age 50 and you start withdrawing at age 60, then you're good. You don't have to pay that 10% fee. But if you withdraw at age 57, well, there's an early 10% withdrawal penalty from the IRS. So pay attention to that as well. So the fixed annuity advantages are the guaranteed interest rate for the fixed annuity. If it's a 5% yield on a 5-year annuity, that means you will get 5% every single year. Even if the market crashes 20,000%, doesn't matter. You get a fixed rate of 5%. On the flip side, if the market increases by 10%, you only get 5%. So it's fixed. Then there's the tax advantage growth component. So let's do some math because we love math. Let's say that you put $100,000 into a 5-year multi-year guaranteed annuity, MYGA, and it's compounded yearly with a 5% fixed interest. So if you do 100,000 times 1.05 to the fifth power, that's $127,628.15. And that's not paying any tax at all because it's tax advantage growth. But then after the 5th year, you pay whatever your tax bracket is. Like say you're in the 22% federal tax bracket, then your return is, well, you have $27,628 in growth. You multiply that by your tax bracket, then you add your $100,000 of principal, and you're left with $121,549 after tax after the 5th year. And then there's this little calculator in the description link below if you want to just, plug in your numbers of 5%, 100,000 per year, 0% tax bracket to not have to do as much math. So you have this much before taxes, and then after taxes, $121,549. However, if you had no tax deferral and just put it into a regular brokerage account and had taxed growth, and you were taxed at a 22% federal tax bracket every single year, and let's assume you have no state tax, then you would earn only $103,900 in the first year, as opposed to $105,000 in the tax deferred growth. So after 5 years of 5% compounding and 22% tax applied every single year, you only have $121,081, which is about $469 less than in the tax deferred growth of the $121,549.96 that we had before. So if you do the math, that's about 0.47% less return, which isn't a significant difference, but this is assuming a 22% tax bracket only after 5 years. If it was a longer period or a higher tax, then you would get affected more and pay even more taxes, Again, you can just plug it into the calculator and not do as much math. But there are some other advantages. First of all, you may be able to do a 1035 exchange into another annuity and keep deferring tax. So you don't pay the 22% after the 5th year, you just put it into another annuity or renew the annuity, and you keep getting that tax deferred growth and keep getting those advantages. Do realize though, when you get the money after, like say, the 5th year, all of that interest is now taxable in that 5th year, which could push you into a higher tax bracket, and you might have to pay a marginally higher tax rate. Alternatively, you could choose to annuitize the payout, like say have monthly payments over 5 years, which would then make you pay less tax since you're spreading your income over a longer time frame and you have less income to tax each year. And then the whole point of this video was about guaranteed income. So if you choose that option, then you can have guaranteed income for life with your fixed annuity. Another good component is that there is some liquidity. So you can possibly have maybe 10% withdrawal every single year without any penalties. There is also a state guarantee association for every single annuity. So if the insurance company goes bankrupt, you still have your annuity value because of the state guarantee association. Now, let's talk about those disadvantages. They could have lower returns. Their returns are about similar to CDs. So the S&P 500 over the past 50 years has had an average return of 10.331%. So annuity rates are typically lower than 10.331%. So you don't get those market returns. But it is more stable, which is probably what you want during retirement. There's also surrender charges, which could limit the amount of money you can withdraw every single year if you need the money now. And there's that 10% IRS penalty for withdrawals before you're age 59 and a half. So let's give an example of a lifetime income. So let's say there's a living benefit rider. Living benefit riders guaranteed a defined payout while the annuitant is alive. The annuitant is the person receiving the income payments. So let's say the contract value initially is $50,000. So that's the principal amount. That's how much you put into the annuity. Then you opt in for the guaranteed living benefit rider, which is a 0.95% annual fee. Typically, they're around 1%, so this makes sense. And then let's assume for the first year you get 7%, which is pretty good for an annuity. It's probably not going to be that high, but let's just pretend and say it's that high, okay? That means you get $53,588.50. So, with the annual fee of 0.95%, that's a $590 charge for the optional rider. After 10 years, your principal grew to $90,000. So, that's about 6% return every single year, tax deferred. But let's also say there's a minimum income base attached to this rider. So, if you don't withdraw anything for 10 years, they're going to double the eligible premiums, the initial premiums that you put in, which was $50,000. So now the income base is $100,000, no matter if you did less than that. So even though you only had $90,000, after the 10th year, this rider came with a 200% eligible premiums income boost. So you got $100,000. And then, since you waited 10 years, you can withdraw 7.5% in lifetime income for the remainder of your life. So $100,000 times 0.075 is $7,500 every single year for the rest of your life. So that's an example of how you could get lifetime income. But what does that actually mean? So there's this little calculator that can help you decide if the annuity is worth it. Let's say you have $100,000, right? Which is what you had after the 10th year, and it earns an average return of 4% before taxes. Depending on what you invest in, it could be higher than 4%, but I'm just going to go with 4%. And you plan to withdraw $7,500 each year, and you can increase this withdrawal amount, but I'm just going to leave it constant because, inflation makes things more expensive, but we're just going to assume it's zero for simpler calculations. And then let's say your tax bracket is 10%. So with those assumptions that I put into the calculator, which is in the description link below, your $100,000 that's growing at 4% is projected to last 18 years with systematic withdrawals every single year, totaling $136,439. So with these assumptions, if you lived longer than 18 years, the annuity might be the better option, because even though this would have lost all of its principal and income generation, your annuity is still guaranteed to give you income after 18 years. So if you live for 20 years, it might be a good option. And then this little table kind of shows you the taxes and withdrawal amounts involved. So by the 18th year, you have withdrawn most of your money, and by the 19th year, you have nothing left. But do also consider that there is a death benefit involved as well, so you can pass that on to your beneficiaries. And then in another example, if it's 6% growth every year and only a 10% tax, your money is projected to last 24 years. If it's 6% growth and a 22% tax, it's projected to last you 21 years. So this is highly dependent on what your growth rate is and your tax bracket. But if you want to have that peace of mind with the annuity, you can choose that option, although it might be the better option or not. Depends on your risk and your tax and your growth. And then this is a little graph that came with the calculator. So after the 21-year period with a 6% growth rate and a 22% tax, that's what you get, 21 years of income. Now, what are the annuity rates currently? So this is on December 22nd. The link to the comparison tool is in the description below. Also, hit that like button and subscribe. Leave some comments. So this annuity, which is an MYGA plus 5 by the IBX Life and Annuity Insurance Company, has a A- rating, which is pretty good in terms of credit ratings. Max issue age of 85. So if you're older than 85, you can't have this annuity. You have to put a minimum of $100,000 in, which is a lot of money. This one you only have to put in $20,000, and it has a higher credit rating. But A is still pretty good, right? This one locks you up for 5 years. There are no penalty-free withdrawals in the first year, but there are in the second year. And the guarantee period interest rate is 5.51%. This one, which has a lower premium, is 5.5%. And so you can, choose your state and then the amount of years you have and sort by highest to lowest. But these are the highest annuity rates as of now, which is pretty good in my opinion, but it all depends on your risk tolerance. So that's one comparison tool. There's some other calculators in the description below as well. And then if you compare that to other fixed incomes like CDs, certificates of deposits, a 5-year one is 4.75%. A 1-year one is 4.75% as well. So this one was 5.5%. This is lower at the moment. But, the Fed is hiking up rates. It might be higher in the next few months, next year. Who knows? But right now, that's the rate for CDs. And then US Treasuries, about similar. So at the moment, annuity rates are higher. But the Series I savings bond is 6.89% for those issued between November 1st, 2022 and April 30th, 2023. But you can only invest $10,000 per year in those I bonds. So, some key takeaways. Annuities can be a good option, especially for those who are taking withdrawals after age 59 and a half, but it all depends on your risk tolerance, the growth rate, the tax, and all these other different factors. So, make sure to do your own research. This is not financial advice, this is just for the education. And you should definitely compare different yields, compare different annuities, and check out if it makes sense for you. All the links and resources are in the description below. Hopefully you enjoyed this video, you learned about lifetime income, and you became more educated, more happy, and hit that subscribe button, like the video, comment below what you think, give me more ideas, let me know if I missed anything. Thanks for watching. Have a wonderful day.